Hi, I'm Mike Gassewitz, CEO of IAIC. Welcome to another episode of In Focus. Today I'm joined by Steve Cornell, a portfolio manager with us and responsible for our financial sector. Welcome, Steve.
Good morning, Mike.
Great to have you. Thought maybe we talk about the year that was 2022. Basically, maybe you could, first of all, financials, that's banks, insurance companies, wealth management companies as well. And maybe give us a feel for, how did we finish the year? How did 2022 look? And then maybe Q4 in particular.
Okay, yeah, sure. The results were pretty decent in a pretty tough environment. There were certain positives and negatives. The banks and insurers and investment banks, they're all fairly diversified, more so the banks, traditional banks. They've got very diverse businesses. And so each business was affected a little bit differently last year. And the biggest driver, of course, was the high interest rate move, the quick and significant move. And the other big catalyst last year was the persistent low unemployment rate. And so both of those factor in pretty strongly into the results for the finance sector. The biggest contributor to earnings, one of them anyway, was net interest margin expansion. So with rates moving up so significantly, we saw huge increases in net interest margins. And that really did produce a very nice large tailwind for earnings. In the fourth quarter, we did see the net interest margin expansion start to slow down a little bit for most of the banks. And that's not surprising. The increase was quick, and it takes a bit of time for these new higher rates to work through the system. So the banks right now have these deposits. A lot of them, they're not even interest bearing. So that really contributes to margins. So that will slowly change as the deposits start to get invested in interest bearing, which will cut into the margins a little bit. But we still expect pretty decent margins in 2023. But not expanding as rapidly. The other thing was the low unemployment, which I mentioned. And as long as people are working, they're going to be able to pay for their mortgages and their loans. And that's a pretty big factor too. And we're talking very low unemployment rates. So, and then coupled with that is that the banks are very strict on their underwriting and on their loans. So they're not they're very, very, very careful with who they're lending money. They're focused on two key metrics, that is loan to value and FICO scores. And loan to value are very good ratings. And so there's lots of cushion there if real estate prices do come down.
Okay. And sorry, you said what was the other score? Sorry.
The FICO score, which is more of a credit score. I think we maybe have all seen the commercials. You can now get apps which will give you your FICO score as each minute if you want to check it that often. But bottom line is the FICO scores for the loan book at the banks are very good.
Okay. So yeah, you mentioned unemployment makes sense in terms of people and basically paying back their debt and organizations from a default perspective. So that seems like good news. Seems like good news all around. Thought maybe we talk a little bit more about higher interest rates. It makes sense. It's kind of logical. Higher interest rates, better for the banks. And yet the whole point of the higher rates is to eventually slow down the economy, so to speak. So net, do we see, from a financial sector perspective, rates staying high? Is this good as an investor in the financial sector? Is it bad, or is it's just not that simple to tell? Thoughts?
Yeah, that's a very complicated question to answer, and I don't have the specific answer, but I can tell you our view as rates stay high, they're going to work their way through the system. And not everybody is renewing their mortgage, in one day. It takes time. So each day that we move forward with these higher rates, mortgages and loans are being renewed at higher rates, and that's going to bite consumers for sure. So that's the risk out there, and if there's obviously high inflation, this has been the driver for the rates increases. That's also eating into consumers' purchasing power. So as we move forward with these new higher rates, they are going to slowly affect the economy and the earnings of the banks. And there's going to be a crossover point at some, we are enjoying these very nice net interest margins at the banks.
Right.
But then there's that negative of just slower economic growth, more
Right.
expensive loans. And we are also seeing real estate prices start to come down, month over month for sure. And I think that's going to continue as well. So that too will constrain the consumers. So there's definitely things going on that are going to constrain the consumers, which will lead to less lending, less loans taken by these consumers.
Okay. Any standouts from our core pick list? Any ones that you want to highlight for listeners?
Yeah, sure. We've got a great suite of core picks, and they're kind of in the finance sector, and they're broken down, well, in all sectors, but I'm just talking about the finance sector. We've got great picks in traditional banking, insurance, and investment banking. And they all hung in pretty darn good in 2022. The ones that I probably call out are our biggest positions at IIC. Royal Bank enjoyed very strong net interest margin expansion. TD also had exceptional net interest margin expansion. And in the fourth quarter, their expansion actually accelerated a bit, whereas we saw the expansion of NIMs start to pull back a little bit in some of the other banks. So TD really, they saw, the acceleration of expansion. So that's definitely a good call out. And then Bank of America, another traditional bank, the numbers are just incredible. As just a one anecdotal number, their net interest income increased from the previous fourth quarter of 2021 by $3.3 billion. So it's having a big positive. And then the investment banks, even though investment deals, mergers and acquisitions, everything was down so significantly, their stock performance was pretty good, and relative to the indexes. And just recently we saw very nice results come out from Morgan Stanley. Goldman's had a little bit of noise, but they still were pretty reasonable. But definitely a shout out to Royal, TD, Morgan Stanley, and Bank of America.
All right, good to hear. Any more thoughts on the outlook for 2023 in the sector?
Well, I guess going through some of the key points, we do expect the banks to continue to grow earnings and grow the top line. Growth has been hard to come by. That's why we're seeing acquisitions. Low single-digit growth is what we expect there, and low single-digit EPS growth as well. I talked about credit starting to deteriorate a little bit, but it's a normalization of credit. And so credit has been running so well at the banks that it's been well below average. And now we're seeing defaults, delinquencies, etc., start to rise a little bit and trend towards historical averages, which is totally expected, totally normal. And we expect that to continue through 2023. And the nice thing is, as I mentioned earlier, the banks are very strict on their underwriting. So the lending books of our banks, our core picks, are very strong. Dividend increases, share buybacks, that's expected. Continue to enjoy some nice net interest margins. Yeah, I still a great sector to be invested for our clients.
Excellent. Steve, thank you for this.
You're welcome. Anytime.
All right. And folks, as always, if you have any questions about what you heard today or any questions at all about your portfolio, don't hesitate to reach out to your accountant wealth partner or advisor, and or feel free to contact your portfolio manager. Take care.